My name is Stuart Browne. I'm the CEO and founder of PiCap Venture Partners, and I'm going to give you a presentation just about what makes PiCap unique. And I'm also going to give you a sense of the venture capital world and what VCs look for before they actually make an investment in a startup tech company. So now I'd like to chat with you a little bit about venture capital and just kind of give you a sense of what VC is all about, because I meet a ton of entrepreneurs, I see a ton of pitches, and the thing that always kind of blows me away is that as smart as these entrepreneurs are, and as well as they know their product and the market and how they're conducting their business, they're all aware of venture capital, yet they don't really know what VCs think and how they operate. And this is a critical element when you're trying to sell equity of your company to a VC. So as I kind of alluded to, the purpose of this presentation is to give you kind of an inside look into the mind of a VC, and this is to help you determine, firstly, if your company is VC material. If it's the type of company, if it's set up in the type of way that a VC would actually want to invest in your firm. And once you've determined that it's a VC quality company, you can then maneuver that using some of the elements I'm going to discuss within this presentation to put yourself in the best position to make yourself as attractive as possible to a venture capital fund. So VC, among my world of entrepreneurs and startup tech, etc., it's known to be the holy grail of the startup tech world. All entrepreneurs that I meet want to achieve VC funding extremely badly. That's what they work so hard to do. But the thing is even though they all know of venture capital, as I mentioned earlier, very few actually know about venture capital. So here's just a quick definition of a VC fund. An investment fund that manages money from investors seeking private equity, stakes in startup and small and medium-sized enterprises with strong growth potential. Investments are high risk and high return opportunities. So I'm sure a lot of you have heard of angel investors, and of course you've heard of VCs, but what's the difference between a VC and an angel investor? Firstly, the most fundamental difference is that an angel investor is investing his or her own capital. So what does that mean? That means that if you're investing your own capital, you could do whatever you want with it. You could choose to make an investment one year, you could not invest another year, you could invest a tiny little bit, or you could lead an entrepreneur on for months and months and months, and then if all of a sudden you change your mind, you don't have to invest. Also, angel investors have a motive when they invest into a startup tech company. A lot of them invest because they want to do it as kind of a hobby, or they're interested, they want to be a part of the company, they want to mentor the company, some of them want to take more of an active role than others. It's not so much about return all the time with angels. If an angel investor looks at your company and really likes you, the management team, if they really like where you're going, even if it's not necessarily a 10-bagger type investment, they still could be interested in investing in your company because they just want to be a part of the fund. Venture capitalists are completely different because they're investing other people's money. They can't just willy-nilly decide what they want to do with the money. They have a strict mandate that is in a legal structure that says they absolutely have to deploy capital every single year to earn the type of return that they promised they can give to their investors. For example, at PiCap, we're going to be investing $800,000 per year into startup tech companies. We don't have a choice. We absolutely have to do that. We can't just have this huge mountain of money and not get a return on it. The main reason is because the investors in our fund could be doing other things with that money. They could be putting it in mutual funds, they could be putting it into a savings account. They don't want it sitting in our checking account earning no income when they've allotted this small percentage of their portfolio to very risky deals and very high return potential companies. So that's why VCs absolutely have to deploy the capital that they have at their disposal. And so that I kind of touched on the fiduciary duty to investors. we as VCs have to get a very high level of return for our investors. We have strict investment mandates. Unlike an angel, we don't just put our money in something that looks kind of cool and interesting that we will want to be a part of, or have kind of fun mentoring the guys, or maybe become the CEO and just, you know, do it for reasons such as a hobby or interest. VCs are all about return. People give us their money because they want us to do something with it. They want us to get a massive amount of wealth for them. So we have to invest only in companies that can earn us that huge amount of wealth. Another difference with venture capital firms versus angel investors is that we have a very structured approach to scaling companies. When we look to invest in a company, we have a very structured way to analyze it. You're going to hear a bit about that from Peter Lepieni, who's going to be talking next. He's on my investment committee. And then once we decide we want to invest in a company, we have a very structured way to grow that company. We have the ability to analyze a firm, rip it apart, find out exactly what it needs to scale, if it needs to pivot, and we map out that entire growth structure in a way that will bring it right to a liquidity event. So one thing that I really want you to keep in mind as an entrepreneur is that when you go out looking for venture capital money, you have to think like you're a salesman, because that's literally what you're doing. You're selling something. You're selling equity of your business. And as in any type of sales situation, you really have to understand what the customer wants and what the customer needs. But in this situation, you're not selling the product or the service that your company has to offer. You're selling the equity. So you really need to understand what a VC, your customer of the equity, needs and wants. What a VC wants. They want a unique idea. They want barriers to entry, so your unique idea can't get ripped off. They want a compelling value proposition. They want to know that you're going after a market that is huge and that you're going to earn a huge return and that you're going to achieve exponential growth. They also want market traction. That doesn't always need to come in the form of revenue. Market traction could be some sort of metrics that show that you're growing and that people are gaining a lot of interest in using the beta version of your product, or you have a ton of people visiting your website and they're repeat users of whatever you're distributing. They also look at the team running the company. They want to know that you are the guys to pull this off. You're not just, you know, a bunch of kids who have a funky, cool idea, but you have no industry expertise. They need to know that the people backing you, or you yourself, have the ability and the knowledge to blow your company up and achieve a very specific product market fit. And the only way you can achieve that is through industry knowledge. So what a VC needs? Investing in startup tech companies is extremely risky. In fact, it is the most risky type of investing that you could actually do. And those of us in the room who